What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is June 18th of 2018. Well, folks, it's time for a daily update here on the DataDash channel, and today we have a wide range of topics to discuss here on the update. First and foremost, as always, though, we're going to be spending a good amount of time taking a look at market valuations as well as doing some technical analysis on the market leaders. But outside of this, we also have some key headlines to talk about. For cryptocurrencies, we could be closer than ever to seeing Ethereum futures contracts due to a recent announcement by the CBOE. And along with that as well, we'll be spending some time to digest a recent study done by the BIS, so the Bank of International Settlements, basically one of the largest financial institutions on the world, on reevaluating cryptocurrencies, blockchain technology, as well as distributed ledger technology. And outside of that, we'll be taking a look as well at the prices in traditional markets, taking a look at a lot of the major indices, some major hot points in the market, as well as a recent article talking about one nation dumping a lot of U.S. Treasuries as of recent. So we've got lots of things to talk about. Let's not push it off any longer and dive right into the update. So in regards to market valuations, for the most part, we're still pushing sideways, everyone. We've recently obviously tested the lows around $6,000, and because of that, it's been relatively quiet at the moment. We haven't had a breakdown past the even. We haven't actually touched 6,000 specifically. We touched 6,100 on most exchanges the other day. However, because of this and the fact that the market right now is testing for support at these levels, we obviously don't have much serious price action in the market. Most players are in the red at the moment, but at the moment, nothing too serious to the downside, and a few players popping up to the green. Academic has been one that's been gaining like crazy, but to be fair, I don't know enough to really talk on the project or why it's up. But outside of that, we can generally see that markets are pushing sideways. If we take it here to the monthly, we can see that ever since we bottomed down here around 265 billion, we obviously got a rebound, but have moved towards a kind of midpoint between this high and the low. We've been generally stagnant. We don't have the kind of volume we were seeing the other day and are almost close to tethering towards single-digit billion-dollar volume. So we're going down below 10 billion. We're still seeing record low volume in this market. If we take it here to the yearly, we are just not seeing enough to see the market take it any higher at the moment or really any lower. The same levels we saw at this price range back in April of 2018. So again, I'm sorry, I apologize about my webcam was getting in the way. This is generally what I'm pointing towards, guys, is the volume here over here as well is very similar to what we saw back in April in regards to price. So again, we need a catalyst that's going to draw volume into the market to see higher prices. Going down here as well to take a look at market dominance, we can see here on the yearly that Bitcoin market dominance is still holding towards those highs, a little bit above 40%, but we're not seeing anything too bearish at the moment. We aren't seeing an absolute breakdown in markets, and because of that, Bitcoin dominance is not gaining. Again, when markets go into higher levels of risk, we're going to see higher levels of other coin dominance and lower levels of Bitcoin dominance. And it's vice versa when we're seeing a correction. Even though Bitcoin's going down, it should gain market dominance. And at the moment, we're not seeing any serious gains at the moment, but it is holding definitely nice compared to where it was a few months ago. Real quick, before we dive into the TA side of things, guys, I just want to let you know I was recently on the Altcoin Buzz podcast. I'm going to start trying to get onto a few different podcasts and talking with a few other people in the community, networking a little bit. But if you guys want to go check this out, I had a great time talking to James and the rest of the crew over at Altcoin Buzz that run the podcast. I think they just started it not too long ago, so I'll leave a link down below if you guys want to check that out. Would hope you guys would check that out. It's a good hour talk where we just talked about cryptocurrencies, blockchain, how I got started, as well as generally where I see the space going over the next few years. All right, going on towards the TA side of things, everyone. Let's go ahead and take a look here at markets. When we were discussing a few days ago about the TD sequential, what's really interesting is that we actually didn't get the 9-candle pattern that we were looking for. We actually weren't able to have a 9th candle close below the 4th preceding candle in regards to a lower range of price. So because of that, we didn't get what we were looking for in regards to price, and that would have actually set us up for a good level of support. In my opinion, I think that would have been good to see rather than negative, because that would mean there's a reversal coming. It would be considered oversold at that point, overexhausted, and buyers could come in. However, we didn't see that. But it is nice to see more than anything that price is still holding above the key level we're all keeping our eye on, which is $6,000. So With this right now, generally speaking, because we saw the reversal on the TD, I'm not going to be watching it too much at the moment. But for right now, what I am liking is that we've been holding here for the past 5 days. It's very reminiscent of what we saw back here in April when we test this lower range of price action towards $6,000 to $7,000. And this time, to see it down here at this price that we saw back in February, to see multiple days of price action where we're holding here, we're not breaking down, it is very, very healthy. However, at the same time, as we take a look at the hourly, we do not want to see a breakdown below the previous lows, because in that case, we could very well see a breakdown past 6,000 and downwards toward 5 or 4,000 over the coming weeks. However, I don't think that's going to be the case. What you do want to look out for, though, is the 200-hour here at the moment. That is a key indicator we're watching. We haven't obviously been testing this since we broke down past 7,600. And again, this is one of the key things you want to look for if you're going to look at the more short term. Again, we've been talking about how this might have to come down, double bottom, and bounce off. We might get that. We might honestly get a correction backwards and then rebound off price. And that would be nice and healthy to see as well. The main factor you want to look for is if it's going to have a reaction. Bitcoin's price is going to have a reaction with the 200-day. See if that happens. And if it does, if it gets shot down, we might get a test down to 6,200, back down to these lows. You just want to see it hold. If we can hold those lows, then we can possibly move higher and start testing these levels of resistance we have on the chart, testing for a lot bigger, even levels on Bitcoin. Fact of the matter is, this is playing out very similar. Again, if we take a look towards historical price action at Bitcoin, that we might be seeing something, and again, this would be more of the bearish case in the sense of the long-term play, but also a very bullish case in the short term, is that we are repeating history in the sense of Bitcoin's price, where we're having lower highs in regards to Bitcoin's price, as well as holding a key support level. In this case, we're holding around 6,000. In the past year, we saw 400 acting as support for Bitcoin, but with one final rally exiting out of that descending triangle, which we're seeing, which has tended to be a bearish pattern, to be fair with everyone. So we have to see if this is going to hold here, if it can break through and get past that key indicator at the 200-day, which last time in history back in 2014, it got shot down. So that's the main thing you want to watch for here. Is I think either way, in the short term, we're very, very likely to see an uptick. We just need some volume in the market. Maybe that might be with Ethereum futures contracts or a Bitcoin ETF. We will have to see. But, I'm jumping onto the headlines here. Let's go ahead and take a look at a few other market leaders here. You guys know I keep it candid. I have my errors from time to time. But anyways, going here to take a look at the market, we obviously had some buy volume come in on most exchanges after the securities news from the SEC deeming Ethereum not as a security. And this is setting up Ethereum for a lot of positive things, as we're going to be talking about, as I almost jumped into there a moment ago. I want to spend some time here to talk about Ethereum and enjoy, and I guess we'll break the rules here. Usually we do the headlines separate. I want to spend some time here to talk about the recent decision of an individual from the SEC going out and talking about, under their interpretation, that Ethereum is not a security. Now, again, some people have been kind of off and on. We haven't gotten an official statement from the actual organization of the SEC, but at the same time, to have an official going out and saying that under their definition, Ethereum is not a security, it's a pretty viable stance. The SEC would have redacted it probably. They would have made a following statement to say that that was either a wrong case or a right statement. In that case, it's very unlikely they'd come out for a right statement. But if it was wrong, they would clarify it quite quickly. So because of that, we can be pretty confident in the fact that the SEC is starting to realize that Ethereum can be deemed not as a security. And that paves the way for a lot of financial products to be built around Ethereum, just as Bitcoin, which is not deemed as a security, had back in 2017 with the Bitcoin futures. So why not see Ethereum futures? And the CBOE was very, very happy to hear this news. They've been, out of any other financial institution in probably the United States, been probably one of the most open to developing financial products for Bitcoin and other cryptocurrencies. And we all know that the futures contract was a huge, huge play in regards to the bull cycle we saw last year. Well, we could very well see something for Ethereum here over the next coming months. So they had been considering this back since December 2017, but like most financial institutions, many people have been curious as to whether or not Ethereum is deemed a security. Well, with this new statement, we can see right here in the quote that they said they're pleased that the SEC's decision to provide clarity with respect to the current Ether transactions as to whether or not it's a security or not. This announcement leads them towards a clear path to potentially develop futures contracts for Ethereum, something, again, they've been considering for quite some time. So that's the big thing that people need to keep in mind here. When we're talking about futures contracts, when we're talking about financial products, companies have to even consider before they try to get SEC approval if this is going to be something worth launching because of the regulatory barriers. And when you get these positive statements coming through, it can lead the way for speculation and then confirmation in most cases that a product like this is going to be coming out. And it will bring liquidity towards the crypto space and will bring openness towards more financial products. Now, again, everyone has controversial opinions about this. I think most would see this, as do I, in a lot of ways, as positive news. But at the same time, many people have worries about manipulation in regards to futures contracts. And there are some things you need to be concerned about in regards to futures contracts. For the most part, though, many people have been correlating Bitcoin's futures contract with actually keeping the price down since it hit 20,000 or close to 20,000. And to be fair, guys, it's a case of buy the hype and sell the news. I'm not going to tell it any other way. I'm not going to say, oh, it's the evil Wall Street players keeping the price down. No. It was the fact that everyone was trading up towards the futures contracts, the announcement, buying the hype, and then they sold the news. When something officially gets implemented, that's when you're going to have prices drop because it's already been priced in. So again, I think everyone has different opinions on it, but the fact of the matter is, at the moment, it's good to see that there is this continued push from large institutions like the CBOE and hopefully the CME and hopefully a variety of ETF producers to launch financial products for cryptocurrencies, to open it up not only to institutions but also to retail investors who at this point don't have enough incentive to learn how to open up a Coinbase account. It's just not easy for every single individual to get into. Going on here as well, this has been another topic we have to talk about, and this is where I'll get critical. The Bank of International Settlements. As you all know, I've been talking about the Bank of International Settlements for quite some time. If you've kept active with my daily updates and other content on the channel, they are the central bank of central banks. They are a sovereign institution that's based in Basel, Switzerland, that helps to conduct monetary policy to other high officials in central banks and governments and different financial institutions. And they meet many times to discuss different types of topics in the financial space. They really focus on things like GDP, managing monetary policy. But in this case, they have been keeping active and focused on cryptocurrencies. It's a big misconception that, in the most part, most banks, commercial banks, have not really focused that much on cryptocurrencies. At least the average employees of companies. Most don't understand blockchain. Most don't really give a care of it. They're too focused in traditional markets. But the segment of people who lead the financial world are very aware of blockchain technology and its current status. And they just recently wrote a new report on it. And you can see here on CoinDesk and Cointelegraph, everyone's been writing about it. It seems to be the big headline piece at the moment. But I want to spend some time here. I'm not going to digest through all of it because they have a full document here. It's around 19 actual pages of content to digest. And you can go through here. You can read on it. But basically speaking, there's a good video here by Hun Song Shin. I probably pronounced that really wrong, but he's one of the representatives. He's an economic advisor at the BIS, and he discussed in this video, it's a very short, less than 3-minute video, where he talked about some of his positions on cryptocurrencies and blockchain. This is a recent revision that the BIS has been really trying to put out on their stance on cryptocurrencies. And even though they understand that there could be some potential behind it, they are highly critical of it. And in some areas, I'd say rightfully so, and in some areas, I think it's a silly case or argument. So let's go ahead and talk through some of these things here. The first thing they really kind of enforced here is that cryptocurrencies at the moment aren't really fixing a market issue, at the moment. They're saying that right now, cryptocurrencies and distributed ledger technology are very interesting technology, but the question is, what do they fix? And of course, this is something that a bank is going to act as a brick wall when you're discussing or trying to make points to. The big issue that it's going to fix is the fact that you don't have centralized trust. It's already really implemented that, but the big thing is that we haven't realized why that's valuable in regards to removing trust from money or transacting value between partners. There's a lot of have already great use cases such as remittance payments and just international wire transfers. But the fact of the matter is that it really comes in regards to having a currency that is not controlled by a central bank or central institution. So of course they're not going to address that. But they did bring up some good points. And this is something that, again, I think we kind of stay ignorant to in regards to the Bitcoin community. And if we go through the article here, they have some great diagrams on it. And they really focused on things. They also have some updates to the Money Flower. That's the big document that came out back in 2015, and they've been continuing to work on it. But they really focus in on a lot of the inefficiencies of Bitcoin's proof of work. And this is something that, again, I don't mean to downplay. It's a great way in the sense of guaranteeing a high level of security for the network. But the fact of the matter is that the ledger size is going to get much larger if we were to, see this used as peer-to-peer digital currency, as well as the energy consumption. The energy consumption for both Bitcoin and Ether is going to get ridiculous over the next few years. It is going to get exponentially higher. And for the amount of transactions that we're processing, it isn't efficient. It is completely inefficient at the moment. So I think this is justifiable criticism to a degree of cryptocurrencies like Bitcoin and Ether that are using proof of work, because it is going to get very unsustainable at a given point, and we already are on that track at the moment. So I think we have to look for alternatives in that sense. We have to look for cryptocurrencies that might use different consensus algorithms, might use different means of reaching consensus outside of using a ton of power, and build different incentive structures. This is really the biggest criticism that I think they make that's genuinely true to a degree. Now, of course, you could increase the block size and this and that and, things like that. But at the moment, we still have that massive amount of exponential power consumption that's about to hit as we step towards 2020 and further beyond. So I think that they're right in that sense. But again, the real use case, guys, towards their major criticism, which is, I think, fixing a market issue, that's the first thing that Hyun addressed in the video, is removing the central banks, or the need for management of central bank policy or monetary policy from central banks. So I think in the long term, you're going to see it. It's just a matter of allowing this market to form. Again, I reiterate it all the time that this is going through the same phases that gold went through. Gold itself didn't become a stable store of value overnight, and it didn't lose its it didn't always stay with a lack of volatility. It had a lot of volatility through its history, just like Bitcoin and other cryptocurrencies are going to have, as they continue to question as to whether or not they can extract value in and out of those cryptocurrencies as users, along with that as well, as to whether or not this can hold towards higher levels so it acts as a store of value and sees reduced volatility over time. So again, whole topic for another time. If you guys want to hear me talk about that and the evolution of what Bitcoin and cryptocurrencies are going to go through, would love to do a video on that in the future. So let me know down in the comments if you'd like to see that. All right, going towards traditional markets here, let's take a look a little bit at the indices, and then we'll dive into some deeper things in the market. Generally across the board between the NASDAQ, the Dow Jones, and the S&P 500, and the Russell 2000, we saw a gap down this morning, which is practically closed by 11:43. It's currently the time right now on the East Coast, but we can see here that markets have obviously rebounded. It looked like we were going to get a sell-off, but again, we got a reversal here, the price, and with that, once we held here on the previous open on the price, we continued higher on the NASDAQ, and this is going for most indices right now, so we'll have to see where we go for the rest of the day. I'm not so much focused on the daily amount of price action here. Again, it's general across the board. We've been seeing the Dow Jones and the S&P 500 roll over here. And I have no doubt that you have a potential to possibly hold on this level and move higher to see these double top possibly in the market, or just generally test for higher levels. The NASDAQ has been on a crazy rally at the moment. What I really want to focus in on here is some of the other things that I'd be looking to get bullish on, or things that I'm generally focusing on in the market at the moment. Some things that have gotten me worried about traditional markets, and some of the hedges that I'm optimistic on. So let's go through the bearish ones first, things that I'm a little bit fearful of. If we go ahead and take a look at the financials, we'll go ahead and take a look at the financial ETF here for the S&P 500. We can see that for the first time in a very long period of history, we might be actually having a serious breakdown past the 200-day moving average. Now, the 200-day, guys, we not only talk about the importance in cryptocurrencies, but it is heavily important in traditional markets as well. It's one of the most important moving averages for market cycles. And we can see back in 2015 when we had the summer flash crash, that was really the last period when we stepped below the 200-day moving average, and then back here in 2011 as well. So with this, I think it's very, very important to consider these, seeing as we haven't seen a breakdown of the financials past the 200-day since those two times and back in 2008. And now that we're on entering towards the exit of a 10-year credit cycle, and money is getting more and more expensive, I think we need to be very, very careful and watch these financials. I don't think we're going to be seeing much higher levels in the market. And if we get a step down below the 200-day, what we want to be looking for is, if you look at a lot of different financial indicators, you'll generally see that the financials back in 2007 and 2008, they had a step down below the 200-day. And then along with that as well, they came back up as the 200-day was starting to curve down. They tried to retest it, and they got shot down at the 200-day. And I think that's what we're going to see here. It depends on what indicator you're looking at, but it's the same thing across the board. And we also had that with the home builders ETF. I'm trying to think of the symbol off my head at the moment, but generally speaking, that's what we're seeing right now with the home builders. We had home builders go down below the 200-day, a curve back up, a retest at that 200-day, but a shot down. And I think these are two warning signs that you see, because if home builders are going down, it means the housing, for generally, people aren't seeing optimism in the housing market. We might be seeing a topping cycle. And the same goes with financials that are financing the mortgages behind those houses. So again, very, very concerning sign here, especially after the grand sell-off we saw here back in February. We really had a nail down on home builders back during this time period. But the one thing that I'm still keeping an eye on and is still playing out generally as we've been watching it is commodities. Now, again, I'm going to be the first one to say this. I haven't been trading commodities all these years. I've done a little bit of trading, like speculating in the short term, but I haven't been a long-term commodity holder for some time, because I understand that commodities are really the play you want when fear hits the market. And I know that we're not going to get a serious recession or a serious correction until we have a catalyst. The fundamentals can be bad for a long period of time, folks. That's the big misconception that people have. And markets can go through a prolonged period of time going through some of the greatest gains by having some of the worst fundamentals. And that's what we've been seeing for the past few years. And that's what gold has been building up to. We've been seeing these exponential, not exponential, this coiling of price between the same highs we've been holding at around, generally here on the GLD ETF around $130. But gold has been generally holding at this key resistance point. And we've been seeing higher levels of support waiting for the ascending triangle to break out. And now that we're down below the 200-day, as well as on this line of general support that we find between the lows on gold, I think this is where you're going to have one of the last opportunities to really spot gold around this price range for quite some time. Same goes for silver as well at the moment. And I'll keep pressing it, guys. It's the fact that commodities at this moment are cheap. You have the silver below the 200-day still coiling in between this wedge here. If this gets a breakout, I would bet that it's going to be to the upside as well as to gold. And the reason I say that is because of what we see with the Goldman Sachs Commodities Index compared to the S&P 500. We talked about this a few weeks ago. It's still one of my favorite charts I've been watching at the moment for market reversals, because commodities move not always in sync with stocks. And in fact, it's usually the counter opposite. They usually move against one another, or at least in the sense of valuation ratio. So we can see here that we haven't seen commodities generally, or the Goldman Sachs Commodities Index comparative to the S&P 500 at this low of a ratio since 1970. Let that sink in for a second. 1970. That is almost a 50-year cycle where we haven't seen commodities this cheap. And with, for example, the two we've been focusing on, gold and silver, as well as uranium and a whole bunch of energy-based resources in, different ones that we haven't even discussed on the channel, being this low in the market with an over-peaked market, a 10-year bull cycle, it might be the play we want to keep our eye on now. Again, right when people are getting tired of commodities, it's the time to get bullish in that sense. So again, we can look at this chart here. We can see in 1987, in the peak of the dot-com era, these were all periods where stocks were overvalued, and then they had a correction. And you can see a giant uptick in commodities versus stocks. And the ratio can have major fluctuations. This is a 1-to-9 or 1-to-8 ratio that we generally see between these cycles, and they only come around every so often. So I think we need to keep our eye on it in that sense. Gold, silver, uranium, I've been talking about all of those for quite some time. Keep your eye on it. I think it's something important to watch. Going on here, I want to spend some time to talk about a recent Zero Hedge article talking about Treasury yields spiking up recently in April due to the fact that we saw some of the largest selling of Treasuries. So in the sense, obviously, Treasuries are government-based debt, and in this sense, we had one of the largest dumping sessions since mid to early 2016, and before that, ever since 2008. So, why did we have a blowout sell-off of treasuries? Why did we see billions of dollars of U.S. treasuries being sold by foreign entities? Well, if we go down here, we can see that it isn't all the hedge funds out in the Cayman Islands. We are actually seeing buying volume come in there. And it's not from the supposed country that we all think is probably the first to sell U.S. treasuries, China, in the sense of the trade war worries that many people have. No, it's none of these countries, and it's not even Japan. It actually has to do with Russia. Russia had the largest sell-off of U.S. treasuries we've seen pretty much, I think, I don't know if in history, but at least in the past decade, and has now brought us down to the holding levels that Russia was holding back in 2008. So this is a very interesting sign to see this kind of dramatic drop-off in U.S. treasuries. Now, why could this be? Well, it might have to do with geopolitical issues. Not only do we have, obviously, yields rising, in this case, usually it's a cost to get rid of treasuries in that sense, but along with that as well, you also have a lot of things going on in the scenes. The yuan-denominated oil futures, again, this is something that a lot of people don't know about. There was recently futures being traded in oil that were yuan-denominated rather than in the dollar. That's challenging with the petrodollar in that sense. Along with that as well, there's some trade war concerns as well as sanctions being unleashed on Russia. So this is one way that different types of governments, and not just, I don't think, again, we have the photo of Putin here, but I don't think it's just Putin himself. I think it's generally the Russian government. Again, it's a strategy in a sense that you can use when you're having geopolitical conflicts, when you're traditionally holding a lot of debt of a given country and getting rid of that debt, selling it on market, showing that you believe it's too high risk or it's not even worth holding, and exchanging that out for different things. Many people have also conspired as well that Russia is going to continue to drop other financial products like these treasuries and acquire more gold as they've been stacking up over the past few months and years. So I'd like to hear what you all think about this down in the comments down below, as well as all the other things we talked about. What do you all think about commodities, as well as the general stance of traditional markets, as well as what the BIS said and the potential of Ethereum contracts, Ethereum futures contracts? I'd like to hear what you all think about this down below in the comments. But until the next video, everyone, thank you all so much for watching, and I'll see you all in the next one. Stay tuned.